so with no further delay, I hand you over the stage. You told me, Axel, before that you have talked about that topic for several times already, so I invite you to choose the elements that are the most personal, the elements that are the most surprising for you, and the elements that you think, you know what, if I would summarize what's most important, that's most important, and add some anecdotes. I think that would be most valuable for the audience.
Okay.
Thank you so much.
I will try to do my best. So yeah, thanks everybody. So from startup to Nasdaq is the title. And I thought about how to present it to make it not too boring and a bit entertaining and still educational, which I guess is the idea. So I guess first step obviously is you need to build a business that you could even IPO. Yeah? So that's obviously difficult. And I guess many of you are working on that. Just a very little background on Trivago for the few of you who don't use us regularly. It was founded in 2006 in Düsseldorf. Profitable since 2008 and then self-funded up to 2016 when we went to the Nasdaq end of the year. The business is global, active on 55 platforms globally and very, very strong investor into brand marketing, so TV advertisement basically everywhere around the planet and very much focused on having the first interaction with the user directly and then offering a dedicated search product for accommodation and then passing on you to whoever whoever you choose from our partners. Not to bore you too much with Trivago, which I guess is not really the core of the topic. So you need to build a successful business that has a certain scale. I think one of the big mistakes that you can make is to rush to the market too early. And if the market is very hot, like it is currently, you can list, but then the market is cooling down a bit and nobody cares anymore. Yeah? So the big benefit, obviously, of being public is only there if you are public and you matter, and not if you are a tiny stock that nobody cares about. So focus on that first. And I guess at the right point in time, the second question then is, do you want to be public or do you want to stay private? I mean, it's not obviously better to be public. What are the benefits? You get access to capital, and once you're public, it's much easier to get more access to capital. You get strategic input, and that is something that's not as obvious and wasn't that clear to me. When you set up your business, you're obviously working 24/7, and focus very much on what you do and what you can control. And at least we haven't really focused that much on strategic roadmaps, strategic reviews, which competitor is doing what exactly when. And the benefit that you get when you're public, in particular when you're public in a sector where a lot of the other players are public as well, you get access to very specialized, very smart investors that do nothing else other than focusing on one or two sectors. And they basically give you strategic feedback real time, which is something that at least we didn't have access to before, or didn't get in such an efficient manner as we got since we went public. Liquidity for employees is obviously a big benefit. Once you are public, the options are real options and not phantom shares, phantom options, etc. But there's also a cost. It's not only that the listing as such costs, but there is a cost. There's more transparency. So your competitors and also your key customers can actually see how you're doing. They see how much money you are making. They see how your KPIs are developing, which can be good, but tends to be not so good. And there is obviously distraction, and there are quite significant costs depending on where you list. So why do we go public? When you look at us, our situation was a bit special. We had Expedia as a strong investor with 63% since 2013. And the Expedia had an agreement with the founders of the business where after 3 and 5 years there was a put-call structure where they could acquire 100%, they could sell 100%, but there was no mechanism that if the puts and calls would not be fully exercised, what would happen then? And as a consequence, we needed to do something. We needed to come to a new agreement anyway. And the objective that we had was, okay, we want to have something that is flexible, that allows everybody to increase his share or decrease his share at whatever point in time, whenever he wants. And there, obviously, being public is perfect because you have full liquidity for everybody. So we decided to list at that point in time. Some of the disadvantages that I mentioned before, for us were there already, given that we had a large public shareholder who reported some of our financials anyway. So transparency was there already. Some of the costs were there already because we had a very tight closing process, which obviously costs money because we are consolidated at more than 50%. So overall, from our perspective, quite straightforward to then go for a listing. So the third thing that you need to ask yourself is, where do you want to list? So that is actually more complicated. So when you then start to talk to the bankers, it really depends who you talk to, obviously, but the US is much better, much bigger, much deeper pool of capital, a lot more investors, you get better multiples. I mean, that's how all the discussions start. And when you really look into it, the valuation difference, I mean, it's not really there. Access to investors, the top investors are investing basically everywhere. But to be fair, if you become really big, 5, 10, 15 billion, then there is a much, much bigger bench of smaller investors. I mean, US small investor is 1 to 5 billion. That would be a pretty sizable investor in Europe already. So when you list there, you have more investors that can technically invest into you, and that starts to matter at a certain market cap. The other differences are, on the negative side, if you list in the US, you are subject to the US legal system. Can be seen as positive or as negative. I guess it's a matter of perspective. If you try to look at a neutral manner, it just adds more cost. Yeah? So given that it is case law and that any kind of legal dispute is very, very expensive, you have a lot more legal costs than you have if you go for a European listing. And you have a lot less certainty what exactly is right or wrong. And there's a lot more room for interpretation. As a consequence, you talk to lawyers all the time, basically. The second thing is that the internal control, internal audit regime is different. Sarbanes-Oxley is more rigid and has higher documentation requirements than you would have in Europe. So it's tougher to make it and to be compliant, which is not necessarily a bad thing. So most of the things that you are doing there are the right things. On the negative side, and that is something that the bankers don't really tell you, there is also a disadvantage of being listed in the US, other than cost. The disadvantage is that a lot of the European funds can't really invest into you that easily because you're listed in the US. So if you look at us, believe it or not, despite being one of the largest listed tech companies in Europe, we have basically no European investor. Yeah, so from time to time there are one or two, but normally we would have 95% US shareholdings, which is then the price, I guess, that you pay by listing in the US. And last but not least, to us, if I would have to do it again, I think we would still go to the US, but the main reason all the other points are somehow evening out, I would say. The main point is that for our industry specifically, there is everybody listed in the US, and as a consequence, the analysts that cover the sector are extremely specialized. So you've got banking analysts that just work on online travel, which in Europe doesn't exist. And as a consequence, you have a much, much better dialogue there, and you have a huge leverage through those analysts into the investor community, which if we would have listed in Europe, we would have had European analysts, we wouldn't have gotten to the same extent. So we decided to list in the US. Then comes the next big question, which is when. So bankers are coming up once you're successful, I guess 2 years earlier then it's really a good decision, and come up with all kind of timelines. And 2 years before you need to build your financials, and you need to hire a team, and you need to hire a general counsel, and this and that, and then you have a 6 to 12 month process, and these are the windows. You can go for window 1, 2, 3, pre-Easter, post-Easter, whatever. I think that's all doesn't matter. Yeah, because the way we were thinking about it is it's a huge distraction, and to prepare for something that you don't really necessarily want could be a good decision, but perhaps not a good decision. Yeah? So we didn't invest upfront into a huge structure. We had a team that was preparing German GAAP, no IFRS, no US GAAP, no significant overhead structure that we didn't really need as a private company. And when we decided that we wanted to list, we basically just said, okay, let's do it now. We outsourced everything and then started to hire the team. Obviously, in that moment, more work. On the other hand, a lot more focus and a lot more efficiency before. And I think that you can over-prepare definitely for sure. Yeah? The second thing is then, okay, when actually do you want to list? So once you decide that you want to, there our approach was we want to spend as little time on it as possible. So we decided to list in July and told the bankers, okay, we want to do it in November. Whereas they said, okay, you can probably go for summer next year. And he said, okay, but we don't want to work for like a year on an IPO, which is not really productive. We need to get it done, but it requires significant distraction and involvement from the top management. And we want to build the business, and that is creating much more value than going for the optimal timing in terms of window, market, eagerness, whatever. And I think that's absolutely something that whoever is at some point in time in the same situation, I would advise you to do. It doesn't make any sense to try to time the market and go for something a bit better and a bit weaker and somehow more optimal. The lever is just not big enough. Yeah? So unless you list 100% of your business, if you list 10% and can optimize by 10%, that's 1% of your company value. If you can work on your company for 6 months longer, that should be more than 1% if you do it right. Yeah? So the lever is just not big enough. The distraction is huge. Yeah? So there, I would say July till December. I mean, with the exception of the first 2 months, it's a 180% job for pretty much everybody on the first 2 layers of the company. Yeah? So it's a huge distraction. So now is the question how to do it, and there, I guess we decided to do some things slightly differently than what the banks advised us to do. I would say some rightly so, some wrongly so. I would just like to go through that to share some of our experience there. So how to list, you basically need 5 things. You need banks and advisors. You need historical financials. You need a strategy presentation or a pitch deck, clearly. You need a prospectus, and you need a business plan. Yeah? And so when you look at the banks, what we did is we basically started with one bank, said, okay, you can work for us for free. If you want, the benefit you're getting out of it is that you have a very high chance of ultimately being in the consortium. But we will just work with you now and focus on having a first set of the strategy presentation and to have a first draft of the prospectus. Why did we do that? Not only because it's great if somebody works for you for free, but more so because it's less complex. Yeah? So if you go with a full consortium of banks, where you would normally have, depending on how you do it, 3 to 8 or 9, it's very complex, it's very political, everybody wants to make his point, they start to fight one against the other. Whereas if you just focus on getting the work done with one bank, obviously it's much more efficient. Perhaps not perfect, but the process is faster and it's more efficient. So we picked one bank, worked on the strategy presentation and the first draft of the prospectus, and then on the day where we filed the first version of the prospectus in private in the US, we had a big pitching exercise where basically all the banks that contacted us before were invited for a pitch, and after that we selected then the main consortium. So everybody else came in basically slightly late. And what you need to watch out there for are basically 3 things. One is you need industry expertise, which is important for the strategy presentation, and I come to that in a second. The second thing is sales and execution power, obviously access to the large investors globally, and the team that can just process the deal. And the third thing is something that is post-IPO, probably the most important. You need to have the right analyst coverage. So it matters actually a lot whether a bank has an analyst that is focusing on the sector and understands what's going on versus them just covering it, but not really being into the detail. Because what you're competing against once you're public is the so-called consensus. And the consensus is the average of everybody. And there is no weighting in there. So if the one analyst is extremely smart and understands the sector very, very well, he counts as much as somebody who doesn't care. So it does matter a lot who you have in there, and there are banks picking up coverage afterwards, but the starting point is whoever you have in your consortium. So, so that's advisors and banks. Financials, as I mentioned before, we had nobody in the company who had IFRS or US GAAP experience, so we contacted one of the top four, said, okay, you need to do everything. Yeah, so we need historical quarterly financials, everything for the prospectus. Just do it. And then we started to hire a team into the process, which worked surprisingly well. Yeah, I think it works. Yeah, so it's not the normal way to do it. Normally, you would, if you would talk to somebody, I would say, okay, yes, you do it, and then you practice, and then once it is stable, then you can IPO. But it works as well. So it's a bit more expensive, perhaps, but in terms of opportunity cost, perhaps not. So the third thing that you need is a strategy presentation, and that is actually super important because the pitch deck, I guess, you know your pitch decks, but the key thing is there has to be one slide in there which you take to explain all of your business and your value proposition, and that is extremely difficult to do. I mean, if you have 20, 30, 40, 50 pages, that all doesn't matter if you don't have this one slide. And the only way to come to that slide, and I've done it now twice, you think you have it, and you have a nice presentation, you're very happy with yourself, but then what you need to do is to go out to talk to investors, and the process step is called testing the waters. So you can actually selectively talk to a handful of investors, highly regulated, to really test the market. Yeah? And that is probably the most important part of the overall process, because the first feedback tells you, okay, no, there is something missing. It's not 100% clear what exactly your value proposition and your business model is, because you don't have this one slide. So that is crucial, and the earlier you do that, the better. You hope to get this one slide, and once you have it, I guess the story is done, and also the prospectus to a certain extent is done. So fourth thing, prospectus. With the strategy in place and the presentation in place, it is pretty much, I would say, a legal document, so you still need to go through it. And particularly in the US, you've got hundreds of pages of risk factors. A lot of them read, from a European perspective, pretty weird, because there's like everything is risky. But it is important because whatever will happen over the next couple of years needs to somehow be covered by that risk section, otherwise you will be sued. And have to go through a very lengthy and very expensive process. So last but not least, the business plan. And on the business plan, the conventional wisdom is you need to lowball. Yeah? So you do a lowball business plan because you need to do beat and raise. So what does beat and raise mean? Beat and raise means that you say you do 100, but you plan for 150, and then after quarter one, you say, no, actually, I will do 110. And then people will expect 110, and then you say I do 120, and then you basically raise every time you talk to the market, and everybody is happy, and that's I guess the way it is done. And we said, okay, that doesn't make any sense, yeah? So because it's completely unclear what the risk discount is in the market, and why don't we try it differently and just tell everybody, okay, no, we don't do that. We just tell you what we think. Yeah? So it is a 50-50. It's exactly the plan that we are using internally. So we are very open with the investors. And we are very open with the analysts and said, okay, we will not do that, and it's too complicated. We have an IR department of one person, so we can't have a super sophisticated model where we say one thing and do something else, etc. And that comes with certain challenges, to be honest. Yeah? So I think it's academically correct, but the issue is that you there is the cost of being wrong is not symmetrical, because also in the large investors there is a selling process internally. So there tends to be, in particular for the mega funds, there tends to be an industry analyst who covers the industry, and once he's convinced that it is a good investment, he's then selling it internally to the portfolio managers. So you sell to somebody and he's then selling to somebody again, and he wants to be on average right, obviously. So if you're exactly 50-50, I mean, he's not necessarily happy with you because he's right and wrong basically equally, but he wants to be right in 80% of the cases. So yeah, I guess we have taken a slightly different approach, but to the conventional wisdom, I guess there is a rationale, and that's something that we learned post IPO. If you look at the roadshow and the IPO as such, I think there are also some interesting learnings coming out of it. I guess what you think when you talk to the bankers, and you actually heard about it before, is that there is one point in the IPO where there's a conflict of interest, because the largest clients of your investment banks that work for you and help you to sell your shares high are hedge funds, and they are much bigger clients overall, much more fee volume, etc. So there is actually institutionally some interest to not sell too expensively to the existing clients from another client, which are we in that case. And so so we were pretty concerned about that dynamic. We're aware of it, and we're struggling with it. And I think there we were wrong, because what we saw during the IPO was that there is a much greater level of concentration in the overall investor base than you might think. There are really, I'm probably picking the wrong number, 20 to 25 mega investors that are up in the 800 billion to 1 trillion asset base. So they are as big as 100 normal funds. And they are basically, they make all the difference. Yeah? So an IPO is successful, not successful, if a certain percentage of those investors are backing it or not. So it's a small group. And if this small group sees that there is not enough momentum in the stock, so there's no big scarcity value, they basically push down the price. Yeah? So it is absolutely crucial to come in, relatively speaking, cheap, so that nobody wants to miss it, so that you have a huge demand, or much more demand than you have supply, very early, so that you don't even get into that dynamic, because once you're in that dynamic, that everybody's saying, okay, wait and see, there's no additional trigger that you have to turn it around. And yeah, I think that's something that we didn't do well, that I would do differently if I would do it again. To come back to my earlier point, if you're 10% too cheap, who cares? Yeah, so it's a tiny percent of your overall company value, but the dynamic is much better. So yeah, just in the interest of time, going to some of the key learnings post-IPO. It is very tough to manage expectations. If you're a high-growth company, a tech business where the whole industry is changing very quickly and you don't have any track record with your investors, it's something that we are still struggling with, to be honest, but and particularly in the very beginning is very difficult. Yeah? So we had times where the expectations were significantly different to what we were expecting ourselves, and there's very little you can do about it, because there's they don't really know how you're acting and how you're communicating, etc. So that's definitely a challenge, and I'm not sure that there is really a good answer how to do it well. Asymmetry in being right or wrong, I mentioned before. I think that's definitely something to be aware of and to think through, which we were not aware of. And then the key thing really is, in particular when you have significant movements, is to try to detach the development on the stock market with the atmosphere in the company. Yeah? So we didn't even celebrate the IPO because we wanted to separate what was going on in the business as much as possible from the stock market. In particular, when things are going extremely well or perceived to be going very well in the stock market or very poorly, that is really a challenge. And just ignoring it doesn't really work. In particular, when you give a lot of equity to many employees, it does obviously matter where the share price is. And so there it is. It's not easy to find the right balance. And the way we are currently looking at it, and I'm not sure that it's the perfect balance, is to say, okay, the stock market is basically giving us feedback on what we have done in the past, with some strategic benefit for the future, but it's very much looking at the hard numbers and the performance. And it's not so much looking into the detail, what exactly is going on in the company, what exactly pushed up the numbers a bit more or pushed them down, etc. And it's not really knowing what we are currently doing and what will happen over the next couple of quarters. And that so far worked okay, I would say, to basically detach the atmosphere in the company from the stock market. But we are working on it, and there's no silver bullet, I think. So that was longer than 20 minutes. So sorry for that.
Okay, thank you, Axel, for these insights. I'm sure there are questions. Let's take a seat. Could we have some light on the chairs? Thank you. So from entrepreneur to entrepreneur, not that I managed to get an IPO yet, but still. How does that feel when you actually open? I mean, you mentioned the transparency that you have to deal with and the fact that the very few influential minds from the stock market surrounding actually judge on the value of your stocks. How does that feel as an entrepreneur?
Obviously annoying, in the beginning, because you think you know better.
Yeah.
But I guess after some time you get used to it, and the benefit is it keeps you a bit honest. So because it's a super neutral way to look at it. I mean, obviously the market overall can go up and down a bit, but the investors are looking at what you are telling them and what they can see from the outside. And I guess that happens with everybody, every entrepreneur, every company, that you think something is going on, you're moving in one direction, and you just get another honest data point and feedback from the outside, which is sometimes good to calibrate. So
does it make you more conservative when you think about the vision for your own company, or does it not really affect your entrepreneurial grasp on your company?
I think you have to be very careful not to try to manage a share price on a quarterly basis. That obviously is a problem if you start to do that, but it's not that you have to manage specific metrics in the short term necessarily. I think you just need to have a very clear vision and story what you're trying to do, and you need to show that you're making progress. And if there's no visible progress, I guess you need to ask yourself whether you're on the right track, which is then the part of keeps you honest. There can be periods where there's no visible progress, but if it is for too long, then I guess you need to ask yourself, okay, am I really doing the right thing? Okay,
so you perceive it today more than it's sometimes annoying, but it's actually good, and it's educating us to stay focused and to stay output oriented, and not so much it's overly heated up or people judge on my business who do not understand what we are actually doing. So if you would wait on those two sides.
In the short term, that happens, and you've got all kind of technical aspects of people shortening your stock, and then they need to cover their shorts, and it's going up and down, etc. But if you don't really look at it quarterly, if you look at it annually, then it's actually much fairer feedback point than looking at daily. I mean, if you look at it daily,
that drives you nuts, right?
Yeah, don't. And there's no point, because the data is not, the quality is not good enough to look at it daily, at least not for our trading volume. I don't know if you're Google perhaps, but we're not there yet.
Not yet.
Not
okay,
yet,
let's talk about what needs to happen so this would take place. Before that, of course, we have always the question: how much does it cost? How much money do you have to spend to get the money from the market?
Yeah, how much did it cost? It's actually, going public is not that expensive. Obviously, it costs you millions, but not dozens of millions. Being public comes also with a significant cost. So I would say the going public as such is, I mean, it's not the main cost. It's more if you want to be public, you need to have obviously certain teams in place. I mean, in our case, we have built up a financial reporting team, which we before didn't need. We built up an internal audit team, which before, as a private German company, we didn't need to the same extent. We built up a pretty big legal team. We didn't need to the same extent. So the requirements are going up, and in particular, the indirect functions are growing, and you need to hire a lot of experts. But the cost of the IPO as such, I mean, not that significant. So I'm not sure whether we disclosed the exact number. Was less than 10 million. And we were valued at 5 billion. So as a percentage of the overall valuation, it's not.
Yeah, but as you said, I think that, I mean, yes, it costs money and you need to spend it. It affects cash flow, obviously. However, I think the much more challenging aspect is how do you manage the opportunity costs, meaning the distraction that it creates within your company, right? You said you were pushing it so that you could get it done in November. So how much the overall process, how long did it take?
Yeah, we kicked off beginning of July.
Okay.
And we listed 16th of December. So that's 5 months.
Okay, and everyone told you in advance it's not doable, possibly.
That is correct. Yeah, so, and I guess, I mean, as I said, we took some unconventional approaches to reduce the time further. So that is obviously, that's the main investment. That's much more than the external costs. On the running it, I guess we decided for a structure where nobody really communicates with the stock market other than the finance department. So for the rest of the business, there is no distraction really coming out of it, other than the earnings release, where obviously the CEO is involved as well. Which is something that's not that typical for US companies, where you tend to have some combination of CEO, CFO, investor relations, etc. But there, I guess, when you are very clear in how you do it, then it's not a problem either. And it really reduces the running costs in terms of distraction. Yeah, it does. I see where you're coming from. Okay, what brand is your scarf in? Okay. Where did you buy it? It is. You got a fashion question. It's a Boss Orange. I'm not sure. I would need to ask my wife. Awesome. Your wife buys your clothing? Yes, mostly. Why? No taste, no time. Either we do it together or no time. Oh, okay. Yeah. So you have to say that, right? Yeah. I mean, of course, I could do it myself as well, but you're just too important to buy clothing. No, I don't think that. I don't think that that's true. Okay. What happened to the company culture in month after the IPO? Well, you said you separated it as good as you possibly could. Where did it not work out? I think it worked very well in the beginning. Because I guess we listed in December, IPO price was $11, and then the price was shooting up to 24 within 6 months. Nice. And then it dropped from 24 to 4. So the 11 to 24, I would say, was relatively speaking easy. Oh, really? That's surprising. It wasn't that much distraction. We didn't really talk about it, and there was not really a reason to talk about it, because I guess the only reason to talk about it is that it is part of your personal wealth if you're a shareholder as an employee, and it was going in the right direction. The other direction is a bit more complicated. And we didn't really talk about it for a very long time, and saw that doesn't really work either. Yeah, and so now started to openly talk about it, but in very dedicated sessions, where we basically doing all hands and just talked about the share price development, what the reason is, what happened with the business, which is not necessarily transparent to everybody in the company either, and where we thought that there was market volatility, and what we thought was really fundamental going on in the business. And did your people understand that really? I mean, honestly saying? It is pretty complex, yeah. So it's not easy to communicate. Feedback was positive, but I'm not 100% sure, to be honest. Yeah, so I think there was obviously some complication coming out of that. I'm not sure it really has a direct impact on the culture. I mean, the big cry out in the beginning was because our culture is very entrepreneurial, we don't really have a lot of rules, etc. when you want to be compliant with Sarbanes-Oxley,
that changes a bit.
you need to have controls in place, and a lot. And you need to spend a significant amount of time on documenting that you performed those controls. That process was not so easy, which is not necessarily IPO related, I guess. It's more
like
falling under the US regime, which obviously was triggered by the IPO.
Nice word, yeah. Okay.
And now looking back, I think it was worth it, but it was in the beginning, it was very tough, because whatever you wanted to implement, it was like, oh, no, that is against our culture.
Yeah.
And there is obviously a logic behind all these controls. It is, in the beginning, it is very difficult to really communicate it, in particular when you're used to a very flexible, dynamic private setting. So I think that has a bigger impact than being listed or not being listed or not. You just need to manage the volatility of the share price and make sure that people understand it is not a good proxy for the value of the company on a daily basis.
Yeah, okay. Did you hire people to do that communication work, or did you train the first and the second layer management team to be capable to do this?
We didn't have anybody when we decided in July, so there was nobody working on anything that we needed, so everything was really outsourced in the beginning, and then we really hired this team step by step. No, we didn't get any help or coaching, etc. We learned it the hard way.
Okay, so comes to the next question. How did you select your key team for the IPO? I mean, you mentioned it several times. You did not really prepare, but you just pretty much took the decision and then hired the people who knew it the best. So again, you need an investment banker, you need a lawyer's team, you need, what else do you need?
What do you need? You need a tax advisor.
Tax advisor, commercial advisor.
You need, we had a German lawyer, a Dutch lawyer, a US lawyer, because we are an NV that is based in Germany and listed in the US. Yeah. Fantastic structure for lawyers.
Awesome. They love it for writing their bills. Okay.
Exactly.
I get it.
How do you select the advisors? I guess you just pick the one that you like most. I mean, if you go through a complicated pitching process, that costs a lot of time again. So you said you went
to one of the big four. You just chose a name that you thought is trustworthy, and then picked the team you liked personally.
Exactly. Yeah, it's all about the right team, and I guess when you go through an IPO, you work 24/7 anyway. Yeah. So that is actually quite important, that you pick a team that you can spend 24/7 of your time with. If they're just excellent, but then are complete, whatever the right appropriate term for that is, then it doesn't work either. Yeah? So you need to have a right balance there, and I think we are very happy with our advisors.
Awesome. There was once you mentioned, because this is an aspect that I think is important in this regard, that there is a point in time, pretty late, where the interests of your advisors actually kind of flip side, right? Yeah. Especially your investment bank. So how do you manage that?
I mean, that's what every school book tells you, that there is a point where it's turning, and you have that in a lot of deal-related situations. Private equity is the same. Yeah? So at some point in time, the management is more focused on the buyer, because that's the party they will spend the next couple of years with. What for us the implication was that there was just some mistrust in the relationship. And it's not that you could say, okay, anybody did anything wrong. It's just you know that there is potentially a conflict of interest, and that creates uncertainty. So what we did, we then brought in an independent advisor who was basically trying to bring trust again in the relationship, who didn't have any benefit of going for one investor or the other. Okay. And I think that was money well spent. It was really just to improve the trust in the overall relationship again. Okay, so was it more like a couple therapist to kind of bring you two together personally, or was it more to say, okay, guys, we all know it's transparent. Now we have a conflict of interest, and I will make sure that we will not miss anything that's important for one of the other party? I think it's more like. I've never been to a couple therapists, so so I don't know whether that's the right comparison. But
was it more about the relationship, or was it more about the facts?
I think no, I think it's more about the trust overall, because whatever is said, you don't know whether that is said because it's the best advice or because it's in the other's interest. Whereas if you have somebody who doesn't have economics, he doesn't have the conflict of interest in his view, and he just gives you a neutral view, and you know that view is neutral.
Yeah.
So that just helps you to recalibrate in a situation where obviously you are extremely stressed, not well rested, etc.
I was just about to ask. I mean, you are highly emotionally involved. Any decision you took out of stress or any negative emotion, or maybe too positive emotion, that you would do differently today?
I think when you look back, there are many things that we might not have done perfectly well. One I mentioned is we probably should have gone into the IPO with a much lower price to make sure that there is more pressure on the dynamic very early.
But something that, you know, kind of a outburst, and you said we have to do it this way because it's our company. Something that, with a little bit of distance, you kind of said, oh, that was just an emotional reaction, but didn't make a lot of sense.
I'm not sure. I don't think it wasn't that emotional. I mean, the emotional part was really in the trust base amongst the advisors, and I guess that's what we addressed through a change in process or a team setup.
Okay.
So I think that was rational. Yeah.
So many companies regret doing it all. That's the question, as they are too dominantly driven by shareholder interests and profit maximization. So do you ever think to go private? Actually, someone who is public is not allowed to say that, even if you think you will. You would never answer that question. So, but can you understand that some other companies, not you, obviously, regret that they did it?
Yeah, of course. And I don't use Twitter either. Yeah, so
That's okay.
Of course, but I think there are basically two situations where it is, there are many more, but two main situations where it's a bit problematic. One is if you are too small and nobody cares anymore, because then you've got all the burden and you don't have the benefit. There's not enough trading in it, so you don't even get over a year a fair data point. The valuation is too low. Everybody is frustrated. So that is definitely something. If your valuation is just, or your overall market cap is just too low, it's definitely worth going private. The other one is if you have a very fragmented capital structure, then you need to watch out for the share price.
What is fragmented capital structure?
So if you have no big shareholder and you have 100% free float, when your share price drops from 24 to 4, that is a lot more concerning because you have the risk that activist investors are coming in and just forcing you to do something that is very short-sighted and not in the long-term interest of the company, but perhaps very profitable to them. So that is definitely something to think about. In our situation, it's not as relevant because the publicly traded shares have very limited voting rights. So that's, I mean, one of the reasons why we went for an NV, so you can have low and high vote shares. So there is no risk, which gives you the benefit of really looking at the share price with an annual perspective or whatever, biannual perspective, which is very important. So a lot of the US tech companies go with high and low vote shares, which I guess for a German IPO is not that easy. You can still do it, but it's not that common and not that easy. Alternatively, you just have one larger shareholder that makes sure that you don't have activists coming in that quickly. But that is definitely a situation where it can be very distracting and where everything that I said before will be much, much more challenging.
Yeah, because too much irrationality would get in. So kind of to close up here, you before you came on stage, you talked to someone you, if I understood your conversation correctly, you invested in that other guy's company.
Yeah.
So you obviously changed sides as well and started to invest your own money into other startups. What are you fascinated about? What do you like when you look at other startups and at the entrepreneurs running around in a conference like this one?
I mean, to me, there is one big insight which I don't know, perhaps came to me late, but I think is very important, that normally the companies are not successful in what they were founded for. Yeah, so I mean, Google, yes, was founded as a search engine, but really the big difference came when they came up with Gmail and then started to invest into their advertising business. Facebook, I would also argue, is not the original idea that you see now. Amazon is obviously much broader than what the original idea was. So I think it is very important to go into a market that's big enough, so that you can actually pivot from your original idea, because your original idea is pretty likely to be not exactly right. So, but it gets you into the weeds and gets you to the position where you understand the business, and then you need to be flexible to calibrate and pivot from where you started. Same actually with the company we were talking about before. I mean, they changed pretty significantly their business model, and I think that is something where when I look at companies, I'm looking for, is there enough room to pivot? So if you're wrong and it's a super narrow market, then there might not be space for you to do anything else. So the risk is obviously much higher. And the other thing is, how good is really the team and how flexible are they? And then the third thing is there a good balance of vision and execution? Because that's another challenge, that you can be the most visionary person on the planet at some point in time or at a certain scale.
You need to get your hands dirty.
You need to get your hands dirty as well, and put processes in place and really structure the company to get the full energy out there. And you need some clear focus. And if you don't have the right balance in the founder team, that can be, can go pretty awfully wrong. That's
true. And I mean, you obviously had the privilege to finance your company for quite a while, your own. We had VC on this stage earlier this day, and when you listen to them, obviously it sounds a bit different, right? They want to see the right numbers, and they want to see the funnel, and it all needs to make sense. At the very first place, and I totally understand their perspective because they're not working with their own money, so there needs to be some rationale behind it. But I also think that you're an awesome example how the choice of the timing, not only for an IPO but also for when to get VC money in, can make a major difference. If you need that flexibility or want to keep that flexibility. Well, I think from an entrepreneurial perspective, to keep the freedom on deciding your own what are you doing is a privilege, and something we are for sure, we should, at least it's my experience, fight for as long as we possibly can.
Absolutely.
So doing it in an IPO surrounding, thinking about restricted voting rights or restricted amount of shares that you're giving out, or then balancing who is actually owning those shares, makes a major difference to how well you sleep and how much you can actually still run your own company, right?
Yeah, absolutely.
So congratulations again, and thank you very much for sharing this experience.
Thank you very much.
Thank you.